Target date retirement funds are exceptionally popular in 401k and other kinds of retirement plans, but they may or may not be a good fit for you. And in fact, there's one circumstance where you never ever want to be invested in a target date retirement fund. So target date retirement funds, they've been around for maybe 20 years more or less, and they were created initially because people were making all sorts of bad decisions in their 401k plans. And traditionally, if you're a participant in a 401k plan, you already know this. You and your employer might put money into this 401k plan, and then you have to kind of choose the investments. And a lot of people years ago were not investing their deferrals at all. They put money into this 401k, but then it just kind of sat there in cash and never grew. Other people, if you had a list of 20 different investments to choose from, they would take the money they have in the 401k and just put 1/20th of their balances in each of these funds and just kind of shotgun approach, spread it out equally, regardless of what those funds were actually investing in. And that was leading people to really bad outcomes. So target date retirement plans were created to be a one-stop shop. If you don't want to do any kind of customization, you don't know what else to do, the idea is you can put all your retirement money into this one option. And it's going to be a very, very plain vanilla option to where the risk in the portfolio is aligned with that target date. That's why it's called a target date fund. So if you log into your 401k plan and you see all these years next to some of the fund options, 2030, 2035, 2040, those dates are meant to line up with your expected retirement date, more or less. So if you're 50 years old right now, you probably want to choose a target date fund if you're going to use this option with a year about 15 years out. 15 years out puts you at about 65. That's, in the ballpark of when people typically start to think about retirement. They're meant to be a one-stop shop because every dollar that you put into this fund, the fund manager, once the dollars hit the portfolio, they're going to invest it in thousands of different stocks and bonds and so forth. But as you know, a 25-year-old employee probably should not be invested the same way as a 55 or a 60-year-old employee. That's why they have these different dates. If you choose a target date fund with a date way off 30 or 40 years in the future, it's going to be invested more aggressively, mostly in stocks. And what that manager will do is, as you march closer and closer to that date, they're going to become more conservative over time. Right? So it's a very plain vanilla option. This is not a custom portfolio because the manager it's a broad-based, risk managed approach, and their variable is simply how many years do we have between today and the target date of this portfolio, and they adjust the mix as you go on. So as you can see, that option is much better for a lot of people than just shotgun approach, put a little bit in everything, or just leaving the money in cash. And in fact, today, most 401k plans, if you don't make any investment decisions ever and you do nothing else, they'll automatically put you in one of these funds because they're better than nothing. So target date retirement funds, they've been around for about 20 years. They've helped a lot of people build toward retirement, but they're about as generic as it comes. And when you're earlier on in your career, you're starting to put money into the accounts for the first time, that might not be the worst thing, right? If you don't want to do anything else, you don't ever want to log into your account again, might not be the worst thing in the world just to dump it in one of these funds that is going to be mostly invested in stocks, because you have so much time between today and when you might need to use the money in retirement. That being said, these funds vary widely provider to provider. And what I'll do now is throw up on the screen here the asset allocation of a 2045 target date fund that's managed by Fidelity. And you can see that this fund has most, I'm going to go to the summary here. There we go. It has most of its assets in stocks, right? As I sit here recording this, 2045 is about 20 years away. So it's got 87% of the account in stocks. It's got some bonds, a little bit of cash, and a few other items. These are probably bond derivatives, real estate, that kind of stuff. Now, if we look under the hood, A lot of those stocks are in companies domiciled outside of the US. In fact, 37% of the entire portfolio is in non-US stocks. Now, let's take a look at a different fund. This is going to be the Vanguard 2445 fund. The ticker symbol is VTIVX. You notice here that largely the high level allocation is kind of in the ballpark, although it's got 5% less in stocks than the Vanguard, or excuse me, than the Fidelity fund does, which is a reasonable disparity. Now, let's take a look at the next level down. It's only got 33% in non-US stocks, which is a smaller portion than the Fidelity fund, but the way that they build the bonds is completely different too. They have a lot more in non-US bonds than US. The majority are US investment grade, but unlike the Fidelity fund, they have a nice holding in non-US bonds as well. All these different types of investments, these different asset classes, they have different risk and return characteristics. They're different investments. They do different things. So even though they both of these options are dated with the year 2045, their allocations to equities, the growth portion of the portfolio, they differ. And there are other differences, pretty stark differences when we look under the hood. So if you're going to use one of these things, you probably want to take a close look at it and just confirm that it resembles what you think it does. Because how you do with your portfolio depends on the asset classes that you're invested in. You're putting your hard-earned money into the 401k plan. It's important to make sure that those dollars are working for you in the way that you really want. And if the target date fund that's offered in your 401k plan is not adequate, well, you probably have some other choices to choose from. You just need to do the legwork of picking and choosing between them. Now, there's one specific circumstance where I don't think you really ever want to be invested in one of these target date retirement funds. And the reason is that they're as generic as it comes. The managers of these funds are managing the funds to the specification of thousands and thousands of people. And that might be okay when you're early on in your career putting money into these accounts for the first time, because probably you just want to put all your retirement savings in a wide swath of stocks and then just let those stocks grow. The closer you get to retirement, the more you need to finely tune these things. And when you make the transition from going in your working years where you're earning money and making deposits and contributions to these accounts, to actually being retired and trying to come up with an income plan every year where you're drawing money out of your accounts as part of your financial and retirement plan, I don't think you ever want to be invested in a generic target date fund at that point. It makes absolutely no sense. So let's bring up a couple of different target date funds with the year 2025 to resemble someone that's just stepped into retirement. As you can see, here's the Vanguard 2025 target date fund. The ticker symbol is VTTVX, and it is really conservative. It's got 50% in stocks, the other 50% in bonds and cash. That might be a great allocation for a lot of people. But as we were saying, Vanguard has a pretty high portion of non-US bonds. That's, generally a good thing. They also use inflation protected and investment grade bonds. Let's take a look at a different one. A different 2025 fund. Let's go back to the Fidelity fund family. FFTWX is the ticker. It's got fewer non-US bonds. Looking at the summary, it's also about 50-50. It's got a hair more in stocks, 52, 53%. Bonds are about 45%, and there are other differences under the hood. Now let's look at just a third fund family for comparison's sake. T. Rowe Price is TRRHX. This is one of their target date retirement funds. I think they have the highest allocation to stocks at 53.5%. That might not be enough stocks for a lot of people stepping into retirement. And that's my entire point. If you're 65 years old and you're stepping into retirement, that means that you're giving up your income. You're no longer putting more money into the account, and you're hoping that your hard-earned savings are going to be enough to last you the rest of your life. This could be 30 years or longer based on life expectancy these days. maybe less, maybe more. We don't know. We don't know the ultimate date that we're all going to expire. We don't know what our health and medical costs will be in retirement. We don't know whether we're going to need a whole lot of long-term care services as we get older. That's what makes this retirement um, calculation, the math behind the retirement, so challenging, is because we're just working with a whole lot of variables that we don't know, right? So when we get to that point, most people should probably have a little bit more of their portfolio in growth assets that are going to grow and keep their options open over this 30-year period or longer, at least more than 50%. Again, this is a generality. 50-50 might be a great allocation for a lot of people. The point is, when you hit that jump off date where you give up your income and hope that your hard-earned savings are enough to last you the rest of your life, you probably want something a little bit more custom that's designed to your specifications and will grow over time, at least by a little bit, to give you more options if big expensive medical procedures come up, or if you want to give a big bequest to the kids or grandkids while you're alive, or some combination, whatever that looks like for you. You get my point. Generic might not be that bad of a deal when you're really young and you just want to buy a whole bunch of stocks and you don't have a whole lot of money in the account. As you get closer to retirement, as you put more money away, the element of jeopardy goes up and your margin for error goes down. So it's really important for most people to build a custom solution as opposed to using a target date fund at that point. Be sure to watch some of our other YouTube videos on managing taxes and building income in retirement, and download the 5-step retirement income plan that will show you exactly how to do it.